I say, man, China central bank just launched what we typically known as quantitative easing. And this is a big development. As a result, the overall stock market all lifted up. And let's see whether this thing will last. Let me give you my analysis of what I think will be the outcome moving forward, the options that are likely to happen. And I'll take a chapter from some international experience and share with you. And I'll give you my conclusion whether this will last or not last. Let's watch until the end, shall we? The big thing that's happened over the last few days is to see the Chinese central bank launching what I call quantitative easing. And everything should go up from now, right? Just up all the way. Seeing what has happened in US should happen today. But let's watch on, shall we? So before we go on, remember hit like and subscribe, and we'll give you more real-time updates of economic activities, stock market related news, and some of my personal reflections. So remember hit subscribe and like to our channel. Okay, I'll be launching almost a video every day. So let's go. So the Chinese government recently launched a powerful stimulus package. Okay, and according to South China Morning Post, China fired policy bazooka to boost economy led by mortgage rate cuts, property measures. And the rate cuts supported to the acquisition of real estate companies, land bank, and new tools to boost capital market among the measures rolled on Tuesday. I've been trying to look at more neutral news agencies. A lot of people say that I quote American international news agency that are quite biased. So this is South China Morning Post. I'll try to quote more of these kind of news agency. But I think more importantly is that it is true that China has fired a series of very big measures to stimulate the economy. And interestingly, they have a lot of resemblance to what has happened to US during those times where US economy was down. This talk may get a little bit technical in economics, but I think it's important for us to understand a little bit. I'll try to de-chimanize it in a way to make it not so chim, okay, not so complicated. So first of all, what the Chinese central bank did was to cut the RRR, the reserve requirement ratio. This basically means that the amount of money that commercial bank must keep as a reserve has been cut, right? For example, every time a bank take a deposit of, let's say, $100, they may have to keep about, let's say, just arbitrarily, 10% of it in their bank and can lend out the remaining 90%. Okay, so the 10% will be RRR. I don't exactly know what's the RRR of China, but it has been cut by 0.5%. And usually this is a powerful stimulant to increase lending into the economy. So the cut in RRR is expected to provide liquidity of 1 trillion yen, okay, $141 billion US equivalent into the market. And the other thing that they did was to cut the mortgage rate for existing housing by 0.5%, right? So this one, not too big a deal because the US cut their interest rate by 0.5%, China cut by interest rate 0.5%, so that's come to parity. But this 0.5% cut in interest rate hopefully will stimulate some market. So the People's Bank of China Governor Pan Gongshen, okay, Pan said that there's a repo rate cut, okay, the 7-day repo rate will be lowered from 1.7% to 1.5%, which effectively lower the medium-term lending by 0.3%. And the loan prime rate by 0.25. This is what we call an amount of money that the banks have to keep with the central bank, right? So that will be lowered as well. And fourth is that the down payment ratio of the second home purchase will be reduced from 25% to 15%. So it's encouraged people to buy a second home. So they lower the lending ratio. And that's a very strong intent to increase property purchase, given there are so many unsold homes and property prices have been crashing. So these are big moves by the People's Bank of China, right? Basically, it's a central bank. Interestingly, this is a move that is rare to see outside China. So Pan also reiterated a support for a $300 billion yuan fund that was set up in May to encourage local government to buy up unsold homes and convert them into subsidized housing. So the loan, which 60% was funded by central bank, will see the ratio lift up to 100%. A lot of stimulus given into the economy to help to clear up some of the unsold home. Then there is the Bank of China also said that insurance company, asset managers, and security firms could use bonds, exchange traded funds, and single stock holdings as collateral to swap with the central bank treasury deposit for $500 billion yuan to invest in stocks. So they're not only trying to stimulate spending, they're trying to stimulate property, they're also trying to stimulate the stock market as well, right? So encourage people to buy stocks. Public companies, meanwhile, could borrow a new re-lending facility as much as $300 billion yen to set up by the PBOC for share buyback purposes. So a lot of initiative have been given to stimulate the economy in a 360-degree way, and thus we should see some effect according to Wall Street banks, right? Absolute positive rescue package set to trigger big stock market rally. So the central bank not only gave stimulus to everybody, they also give it to consumer. So enticing people to go out and spend money, Shanghai will dole out $500 million yen worth of consumption vouchers, right? An announcement that came out a day after central bank fired off a bazooka policy to revive China's struggling economy. So the vouchers are worth $360 million yen will be distributed to people to save money when dining in restaurants, hotel stays, movie discounts, attending sports events, and so on, right? A bit like our vouchers that the government give us, okay? And China to also offer living subsidies to a disadvantaged ahead of PRC founding anniversary. So a lot of giveaways to try to encourage people to spend. So to no surprise, the whole stock market rallied. The Chinese stock market, SSE, the Shanghai Index went up by 12%, okay, over the last 5 days. And the Hang Seng Index went up by about 12% as well. Huge uplift over the last 5 days. So let's take a look at where the stock market is rising, okay? Of course, at its current level, is still below the peaks of the Hang Seng Index, and also, of course, below the peaks of the 2008 and 2015 levels. But it's a great encouraging sign to see the Chinese stock market rising. So let's take a look at what the analysts say, right? Before Mr. Lu give his opinion. So is the stimulus good enough? So this time around, I actually picked analysts that are more neutral. So I've read through and watched a lot of analysts giving both sides of a picture. I thought the most fair one is actually the one by UOB Kay Hian, Chief Investment Officer. I think he's a Chinese himself that probably came to Singapore, okay, Mr. Chiong. And let's see what he says, shall we? Basically, what he says is that the size of stimulus is not big enough. In 2008, the China government launched about 4 trillion yen of stimulus. The current stimulus is much less than the one in 2008. Wall Street has estimated that it takes about 3 to 5 trillion yen per year to save China from deflationary pressure. So whether versus 2008 or Street expectation, we are still under delivering in terms of stimulus. Shanghai, for example, is launched a 500 million renminbi of stimulus. I must say that the amount is laughable, but the effort is commendable. 500 million renminbi stimulus is nothing to the whole population of Shanghai, which is very big, okay? But the effort directionally is correct, right? So maybe this is round 1, and then you go round 2, round 3, round 4, right? But the scale is not big enough. The other thing that they talk about 100 over billion dollars of stimulus for the whole of China, just to compare. Singapore, during the COVID time, our stimulus package was $100 billion, right? Sing. But that's for tiny little Singapore. So for humongous China, 100 billion over, USD, maybe that's about 2 times that of Singapore. It's now you see the picture, right? For Singapore during COVID time, we allocated $100 billion for a small, tiny Singapore. For the whole of China, 100 over billion dollars USD, I think is probably not enough. So I can understand why people say that the size of stimulus is not big enough. But this view is not just the view of UOB Kay Hian, Chief Investment Officer. We also see some of these comments as well. In South China Morning Post, is China new stimulus a strategic pivot or a short-term tactical move? Right? Some analysts see panicking among China policymakers, and others point to a rising urgency to fight deflation. Right? So the latest package is far from enough to arrest the current economic downturn, as fiscal stimulus should be further ramped up, the analysts say. So Larry Hu, chief economist at Macquarie Capital, said that the Chinese central bank pivot signals a broader shift in policy stance, though more fiscal spending is needed to end the longest deflationary streak in China. This could be beginning of the end, right? So that's a good thing. Again, right? So Hu also says that is just too small relative to annual household consumption of China of 49 trillion yuan. So, while the number look very big, a lot of fanfare, but I think the amount is too small. Now, this could be round one of many, many rounds coming, right? So this will first shot, maybe a fire 10 or 20 shots, then the amount could be very big. But just looking at the scale of this round, it's a right direction, but the shot is too small. So this is where I give two scenarios, right? This is Mr. Lu's now analysis, and this is where economics comes in. Let's see the two possible scenarios. Let's take a chapter from what happened to other countries when they fire quantitative easing. This is what economists say expansionary monetary policy, right? And in model terms, they call it quantitative easing. So in 2007, 2008, quantitative easing, during the Great Recession, the Federal Reserve fired three shots, right? QE1, QE2, QE3, and they stimulated billions of dollars into the economy, right? Then the S&P 500 went up and up and down and up. So basically it kind of lifted up, and it certainly does help to lift up economy. I need to say that what has happened in US may not exactly be applicable to China, because no two economies are like. Let me say a few things that you easily understand this. Number one, the US dollar is an international currency, and the US Federal Reserve knows that. So when they print money and spend, like what they did in QE 1, 2, 3, the whole world have to take this printed money, So it's a bit chao guan of the US Federal Reserve. So it's not fair, but life is not fair, right? So when the US print money, the whole world has to take their printed money. So the whole has to tahan, so as to say, you borrowing a Malay word, have to tahan their printing, right? So the negative impact is spread out towards the whole world. So that's why, the negative impact, which largely inflation, will not be so painful, okay? The politics of US, however complicated we may think it is, it's actually not so complicated. There's a president every 4 years to go for election. Every 8 years he has to step down. A new one has to come in. So there's no accusation of dictatorship, and there is real so-called almost real democracy. I think everybody will agree that President Xi Jinping is likely to stay for quite some time, okay? And he has changed some rules to allow him to stay for quite some time. And if he is good, the policy will continue good. If he is deemed not very effective, the policy will continue not so effective. So the politics cloud the whole thing about China. And at this juncture, China is in a trade war with many rest of the world. Many parts of the world, treats China with a lot of scorn and fear, and trade war are always lingering and things like that. There's a lot of import tax here and there from the rest of the world that's imposed on China. At that point in time, US is not in such an environment. So while QE 1, 2, 3 during the Great Recession was impactful for US, to assume that this thing will now happen to China is quite a quantum leap, okay? Not say it won't happen, it's just quite a quantum leap. My personal fear is that this thing smells more like a typical case, what we call a liquidity trap. Some of you may think that Mr. Lu coined up this term himself. No, it's not, okay? A liquidity trap is actually an economic term that well describe what has happened to US in the Great Recession. Is also well described what happened to Japan, and possibly could be the scenario that China may face. Now, it's not 100%, but let's look at what liquidity trap is, okay? Liquidity trap is an economic phenomenon whereby you embark on huge expansionary monetary policy, quantitative easing, and there's no effect. And it's quite easy to understand, and once I explain it, okay? Liquidity trap, according to Investopedia, is when consumer investor hot cash refusing to spend, rendering monetary policy ineffective. Well, and that has happened to Japan, right? Japan lowered the interest rate, lower interest rate, but yet it still has deflation, which basically means people don't dare spend. Now, in the case of China, it could simply means that all these moves are done, lowering interest rate, lowering RRR ratio, lowering this rate, that rate, encourage people to spend. People just don't spend. People are fearful. The more they spend, the more they lose, right? They have a very hopeless view of what's going to happen in the future. They have lost faith in their government. They lost faith in policies. They lost faith in economy. So they decided not to spend your whole cash. You can lower as much interest rate as you want. You can give me as much as you want. The more you throw money at me, I keep. because tomorrow I might need them, right? So this is what we call liquidity trap, and it's happened quite a few times in the whole world in the history of economics. These are characteristics: very low interest rate, near or close to zero. We're not there yet, okay, but the Chinese government is gradually lowering. Economic recession, I'm not too sure whether Chinese economy is in recession or not. Okay, they are trying to hit a 5%, but I do know that the unemployment rate is very high. A high personal savings rate. This is definitely happening in China right now. Low inflation or deflation rate. Yes, this is happening right now. Ineffective expansionary monetary policy. So we don't know yet. They have just launched it. It could be ineffective or it could be effective. We don't know. So whether you'll be a liquidity trap or not, time will tell. But it does smell the risk of it. So the last the last Chinese economic video that I launched, many people give a lot of comments, right? They are equally noisy on both sides, right? So just take a look. I just want to acknowledge that I do read some of them. The last one was a lot, hundreds of comments, right? So it's a Chinese economy in a bad shape. Some say true, it is in a bad shape, right? And I say that it's very very risky to invest in Chinese stock because it's a gamble. But a lot of people will agree me then. Okay, agree me then. Now it's made different because Chinese stock went up by, I don't know, 12% or so. And it's true. Everybody will tend to agree that the renminbi cannot replace the US dollar, at least not now. And the Chinese government economic model now doesn't encourage growth. Now, there is also views that, things are not so bad. Okay, things are not so bad. And you can read some of the comments yourself in my YouTube video. Please go watch a video. And of course, there are people who think that the Chinese economy will recover soon. There are people who don't think that Chinese economy is in a bad shape, and this is more like I'm raising a false alarm, right? This and somebody say, yeah, this guy cannot compare Singapore and China, right? And Chinese GDP is still very strong, and everything is still okay. The falling property prices and youth unemployment is a short-term problem, and the Chinese economy has a lot of savings. They'll be able to tide them through, and everybody owns a home, so there is no risk of economic failure and things like that. The Chinese economy has strong, huge trade surplus. So it's not the same like US economy, where there's always trade deficit here and there. And the domestic consumption of Chinese economy is still very strong. And of course, there are a lot of people who think that I'm very biased against China. And I always read news only from English media and things like that. So today I purposely pick news from more towards independent comments or from South China Morning Post and things like that. So frankly speaking, let me give you the view. These are all from Chinese media right now, right? The truth of matter is that if you are not in trouble, you will not throw so much medicine. So this is from Xinhua Se, this is a Chinese official media. China steps up effort to boost domestic economy, right? It's intensifying efforts to spur investment and consumption. Why would you do so if your economy is not in trouble? This is from CGTN, of course, they are Chinese media. Chinese central bank has introduced a series of major policy adjustments designed to boost economic growth and stabilize the property market. So I need to emphasize again, right? You will not provide medicine for the economy if there's no sickness. And if you think that I'm bullshitting about the unemployment, South China Morning Post actually came out and said that, the youth unemployment rate has rose to 18.8%, even higher than the last figure that I've commented, 18.8%. This is South China Morning Post, okay? So in conclusion, I think there are a couple of things that I want to say. Number one is that if the economy of China has been okay, the Central Bank of China would not need to have launched quantitative easing. Right? It's a big, huge move, And we all have to recognize that they launched it because help is needed in the economy. So I don't think we should argue on that. I think more importantly is to decide what will happen to the Chinese economy, because that has stock market implication and things like that. The outcome is really difficult to predict, I would say. I'm personally, 60-40. 40% thinks that, they will be effective. 60% think it's going to be landing a liquidity trap. So I personally don't think that, it will be, the round one of this quantitative easing will be effective. You need a few more rounds to probably sustain the firepower. And I also agree with many analysts that the stimulus is just too small. I've personally not taken any bets on Chinese economy myself personally, but I do recognize that a lot of people like to punt and bet on Chinese stocks and things like that, I would just say it's a gamble, right? It's a gamble, and I'm not in a position to be able to decide whether this gamble will come out right or wrong. So let's watch and see whether a liquidity trap will happen, or a 2007, 2008 global financial rescue outcome like what happened in US will happen. Let's watch and see. Let me hear your views as well, and remember, hit like and subscribe, and I'll see you in a day or two. Bye bye.